Today, we're diving into the commercial real estate market, a key area of alternative investments that offers stable cash flow and diversification opportunities for investors. Joining us are three private equity real estate professionals and a public markets hedge fund founder. Together, they'll share insights into their areas of expertise and how they navigate today's complex environment. Let's start with introductions. Can each of you briefly share your focus within the real estate market, whether multifamily, industrial, office, or another area, and explain what makes your niche unique from an investment perspective?
Hi, everyone. My name's Ellie Lupo, and I work at BGO, a large global real estate investment manager with around 84 billion under management. So I focus on private US strategies within a larger global real estate investment manager that covers all major asset types. So we're geographically based and invest across multiple open and closed-ended funds spanning the risk return spectrum, which I think gives us pretty broad visibility into what the private market landscape looks like at any given point in time. Our approach to our investors is that we can really provide a one-stop shop solution for their real estate diversification. So whether they're looking for core plus, or opportunistic strategies, or even asset level or sector level additional diversification, we can kind of tailor that within one platform.
Hi, my name's McPherson. I work for a closed-ended private equity fund in New York. We have 5 billion under management and 10,000 apartment units. We combined the efficiency of institutional capital and funds with the hands-on niche operator focused on four particular markets: Boston, Philadelphia, Northern Virginia, and South Florida. We implement a value-add strategy in more core plus product. We focus on developer takeouts, 10 years and newer, facelift type of execution to culminate value add returns for our investors. We've been doing this for over 50 years, and what we like to focus on is driving NOI, controlling what we control, and timing the market from a disposition standpoint when the opportunity presents itself. We give our investors more of a operator's mindset and focusing on the assets with the flexibility and the efficiency of our relationships and our capital partners to produce results.
My name is Nick Damm. I'm the CEO of Intercontinental Development, which is a private investment firm. We specialize primarily in office real estate with a little bit of flex and some smaller industrial products. Our focus is to be really hyper-local in the Philadelphia suburbs and control our process top to bottom from property management, which we choose to do in-house, to investor relations and really everything in between. And that has allowed us to position ourselves as a group that can provide a little bit more of a direct investment into it for local high net worth individuals while removing some of the headaches of trying to do any sort of exact direct investment of somebody just doing it as a small second business or an investment, which creates management headaches for them. So again, we're focused on just being really hands-on, really hyper-local, and creating value in that way.
Hi, I'm Steve Pei. I'm CEO of a public fund. So unlike the private side, we basically focus on underfollowed cyclical companies, most of which generate cash and income. And our particular focus is in areas like commercial real estate, residential real estate, shipping, chemicals, etc. So basically what we're doing is we're waiting to time the cycle. We don't have to be invested at any time. And so that allows us to be highly opportunistic, choosing when we attack companies at their down cycles. I think there are two things that make our platform unique. First is how opportunistic we can be. So as you're probably aware, most real estate is very cyclical, and most of the players are going, whether they're public or private, are going to be invested at every point in the cycle. And obviously at the down cycle, they're hoping for more capital to deploy on the down cycle. As opposed to us, we have the ability to sit back, be invested in other sectors, wait for things to blow up, and then come in highly opportunistically to take advantage of those cycles. The second thing that I think makes us relatively unique, even across the public space, is we try to marry the skill set of a private real estate player, but in a public form. So if you think about what's happening, a lot of public stocks, the investors that own those stocks are owning it for dividend income. They're not really understanding the details of what those companies own, especially the real estate. So what we can do is take advantage of that knowledge disconnect and come in, underwrite that company as if it was a private company, know everything there is to know about it, and then use that and to our advantage in the public space, capitalizing on that knowledge disconnect.
Interest rates are a hot topic. Real estate and interest rates go hand in hand in a lot of conversations. Given the higher rate environment, how are you positioned and what do you think is most interesting about the current environment?
I think higher rates, what it's doing to our market right now is making the transaction volume a bit more challenging. But what it's also doing is thinning out what used to be crowded fields, chasing these opportunities. So when you're capitalized at the right time, as Steve mentioned, right, when you want to be capitalized when things are opportunistic. And what we're doing right now is leaning on our relationships and our goodwill from many years of activity, having done over $3 billion of acquisitions in the past few years. What we're doing is reaching out to our counterparties, reaching out to the business strategies that we know need liquidity. Those are typically people that we've done business with. And what we're doing is letting them know that we're still open for business and we can operate through challenging environments, especially when there's a need on the other side. So, real estate is a relationship business, and especially within multifamily. And you want to be capitalized at the right time. So what we're able to do now is create opportunity for ourselves at somewhat of a disadvantage to our counterparties, but to create liquidity when there isn't much of it. We think this is a very exciting time to be buying real estate and to be, and specifically multifamily, and to be in the market. In addition, I think what we're really excited about is interest rates make it very challenging to develop new assets. In addition to construction costs being extremely elevated, obviously the borrowing cost to develop that project is also another cost that is run up on developers. We think that there is a very limited pipeline in the medium term, say 2, 3, 4 years out now, as evident with construction starts and permits, et cetera, that there's a lot of opportunity to push NOI as well in this product. Home affordability is, as challenging as ever. So we think the multifamily asset is very well positioned for not only advantageous buys, but also strong NOI growth in the medium term, and which makes us really excited to be buying, at this moment.
Yeah, it's certainly something that is frequently topics of conversation from anybody we talk to in the industry. And I think it's a two-part problem. It's the interest rates, but also the change in availability of capital has changed. One of the major sources for smaller real estate projects has been community and regional banks who have dramatically decreased their lending in the space. It's, as some of the others have talked about, in being opportunistic, I think it does create a little bit of an advantage for those who can make their capital stack up a little differently. For years, the old adage was basically you borrow essentially as much as you can because interest rates were so low, money was essentially free. The conversation is different now, right? With borrowing rates in the roughly 7% range, it changes the calculus, and the advantage of those who are maybe not as reliant on leverage is starting to show a little bit, particularly if you can be in an opportunistic situation and marry that up with how you're funding your deals. It really gives you an advantage in today's market where there aren't necessarily a lot of high volume of deal flows coming through. Transaction volume is down in a lot of different sectors of the industry because it is hard to get deals done today. And so the ability to be flexible, maybe not be as reliant on leverage, is an advantage in today's market for sure.
I agree with everything Alex and Nick said. And there's no question that higher interest rates have definitely slowed transaction activity across the board. I think we have had the benefit of having flexible capital that has the ability to either acquire unlevered, obtain financing after closing, or utilize some of our existing lender relationships to try to achieve better than market terms. But there's a lot of oversupply and a lot of lender-driven distress in the market, particularly on the multifamily side. So that's one area that I think is particularly interesting, especially for investors that might have a long-term time horizon, or the flexibility to buy all cash and to basically acquire newer construction quality real estate, in top locations at times 15 to 30% discount to replacement cost. So if you have the right capital to do this, I think it's a pretty interesting basis trade in the long run.
So we actually love interest rate fluctuations because, as I mentioned earlier, the whole design of our fund is to be very opportunistic and not necessarily have to be invested in any one particular silo. Real estate happens to be our deepest one, and interest rate fluctuations, what they do is they give us cycles. And as an investor that likes to buy on the down cycle, we love the cycle. So today we're investing in publicly traded mortgage REITs, and I can get down into details as to why, but effectively think about it this way: we're buying into the senior lenders on real estate deals, and we're buying in at a discount. So, and we're getting an 11-12% current yield with potential for, north of 20% total price appreciation on top of that. So we view that as a much more attractive place to be in the capital stack, that you're buying in the equity of the senior lender. So if you think about an office property or a hotel or multifamily, that lender's lent at 70% LTV, you're buying at a discount, you're creating that portfolio of properties at 50% LTV, and you're getting 11-12% current income on that, along with potential for price appreciation. So that's what we find attractive, and we can get down into details as to how we underwrote that and why we find it so attractive.
Steve, that's a great point. It brings us into the next question. For those that are new at real estate investing, there's always uncertainties. And what's the one area of the market that's giving you pause right now? What keeps you up at night? What makes you nervous about the investments in mortgage REITs or whatever, you're looking at the current time?
Yeah, so starting from the top, I think one of the things we try to take advantage of is the disconnect in knowledge that a lot of lay public investors have. So, taking a step back, what is a mortgage REIT? A mortgage REIT is basically a public REIT vehicle that is designed to give investors a dividend when times are normal. They're borrowing from a bank at a low rate, and then they're lending it out on senior projects, at the senior level in the cap stack on individual commercial real estate projects. And normally that works really well. They give investors a 9-10% dividend, and you have all these income funds and retail dividend investors that own them. Well, what happens this cycle is interest rates go up, office gets into trouble, and suddenly everyone's seeing terrible headlines. They don't give any disclosure on what they own on the underlying mortgage REIT. So imagine you're an investor sitting here, you thought you were getting a 9.5% dividend. Every quarter there's bad news, guys are cutting their dividend, and they're not telling you what they own, and you don't know what's left. Right? If I gave you a bag of 60 balls, which is like 60 loans, and 20 of them are bad, 40 of them are good, I might know that, but the investor doesn't know that. They just see bad balls getting picked out of the bag every single quarter, and it becomes really scary. So then there's a capitulation and the stocks sell off. The advantage we have is, take, for example, our largest position. We underwrote that over a 2-year basis. We sat there waiting for the right opportunity. They have 53 loans across the country. It's a very major public REIT platform. We know 48 of the 53 properties. That gives us a huge advantage over the lay public investor because, of course, the bad properties are the ones getting reported and going default. The outside investor doesn't know when the buck stops. Meanwhile, we're seeing the portfolio getting cleaner and cleaner and cleaner. And at some point, there's an inflection point where we're like, okay, 18 of the 20 bad loans are out of the portfolio. And guess what? Not only that, these are companies that report every quarter. So if I've got a mortgage REIT and they have 4 loans coming up for maturity, this literally happened last year. They had 4 loans coming up for maturity. 2 of them we knew were already good and refinanced. And then 2 of them we weren't sure about. They were multifamily projects 20 miles north of Austin and in Round Rock. And we're like, okay, there might be an impairment here. Well, the advantage we have in the public market is we know this private property. We can have brokers eyeing it. The minute it gets refinanced, we know about it. And the company's not going to report for 45 more days after the end of the quarter. So we go in with a huge advantage in knowledge over what the public markets is seeing. And that allows us to drive the inflection point. That also means if the cycle turns and things go bad, we can see that on a real-time basis inside the portfolio, just like a private guy can. So that's, I think, the kind of the way we get our margin of safety. But not only that, as I mentioned before, you're attaching at a very, very senior level in the property ownership stack. So there's got to be a lot of pain before we take actual impairments.
No, that makes sense. That makes sense. So what keeps you up at night is the individual property level dynamics and figuring out how to find that
Absolutely. Yeah.
information.
So it
Yeah.
takes a ton of work because, these mortgage REITs go out of their way so you can't figure out what they are, right?
Yeah,
So
right.
it takes months and months of work, and you have got to closely monitor every single one of them. I mean, you're basically just using your connections in the local marketplace. And that's the irony of it, is because all the information is public. It's just knowing where to hunt for that
Yeah,
information.
right. Right. So, Ellie, what are you seeing in your market that maybe keeps you up at night or makes you a little nervous about the the upcoming years and the transactions that you guys are participating in?
Yeah, and not to give you a cliche answer, but I think the biggest unknown continues to be the macro environment. So what is our steady state interest rate environment going to look like, and how long is it going to take us to get there? So to me, this is what's ultimately going to have a big impact on the performance of the investments that we're making today, and when the industry ultimately reaches a full recovery. And I think some of this uncertainty we're also seeing bleed into not just how we're treating our refinancings or new acquisitions, and things like that, but it's also slowing leasing activity on the industrial side. Offices obviously experience a lot of different distress, in the market, both on the tenant side and the landlord side. Just feels like it's slowing down a little bit.
No, that makes sense. As a follow-up question, 18% of the workforce in the US is based in the government, right? They're pulling people back to office. You're seeing companies like JP Morgan and Amazon pulling people back into the office. Do you guys think about the workforce and anything that is occurring in those trends? Do you guys think about that in the office space? And I know, Nick, you might have something to say there as well, but just out of curiosity, are you guys seeing any of those trends that you read? Is the headline trend, is the headline creating a shift in that commercial real estate world that you guys might be feeling?
Yeah, I mean, I think it's absolutely an ongoing debate of offices experienced all this distress, and people are questioning, okay, are we at the floor? Are we at the floor? And I think the biggest challenge has been both on the lender side, because lenders control a lot of those assets now, and also on the equity side of what is our exit going to be? Who are we going to sell this to? Who's going to buy it from us? And I think we're seeing these headlines of JP Morgan, okay, they're going back in one extra day a week or 2 extra days a week. But I don't think we've seen it materialize necessarily in some of the portfolios that we're tracking. Does that necessarily translate to them taking on more office space, and helping ongoing vacancy issues? But I'd be curious to get Nick's thoughts as well.
Yeah. No, it's certainly probably that first thing that's on everybody's mind is what does office look like going forward, right? Right at the moment, it's our heaviest sector by far, and the question is what's going to happen? Does a hybrid model seem to be moving to the forefront? How does that really affect what companies take in terms of space? For the most part, we haven't seen the hybrid model really result in companies downsizing a lot. So that's been something that's sort of kept it buoyed to a certain level. The market is also been, it's not a consistent, hey, office is down 10 or 15% occupancy levels across the board. It comes in chunks, right? Urban areas have felt it a little more over the past few years, and lower quality office buildings, Class C, tertiary markets have felt it more. People continue to talk about an ongoing flight to quality. And a lot of that is because companies that are seeing value in their space, in having the office space, say, basically, I can trade up. I can get the exact size I want, the configuration I want, tweak maybe what's changed over the last 5 years, and trade into maybe a class level or two class levels up while paying a similar amount, because rates have ticked down as landlords continue to try to gain their unfair share of the market because demand is still soft. It's definitely gotten better and it's shifted, right? I think we see a lot of people now talking about these large scale, maybe office to residential conversions, but on a smaller portion of it staying within the office sector, the traditional uses of office have changed, right? A typical accounting firm is probably taking a little less space than they were a law firm, but we've seen some different things come up and fill up some of those spaces. So we've traded out things like professional services for things like mental health, behavioral health. There's a ton of requirements in the market for those types of spaces. So these sort of light medical deals who see value in the four walls, really their business primarily exists in a physical location. The type of user that you're seeing fit the profile has shifted, but that's where the new demand is coming from, as a lot of what we've seen. And in trying to address that, try to design spaces that way, try to be prepared. I certainly think the firms that have been a little bit more conservative over the past few years, and maybe even going back to 7 or 8 years ago, when times were really good and interest rates were low, the companies who kept reserves aside and didn't necessarily take every opportunity to pull every bit of leverage out of the properties and translate it into investor distributions are a little better positioned now. It's unfortunate, but some firms are seeing, hey, look, even if we can land that office tenant, which is a little bit of a difficult task, but even when they land them, they can't necessarily fund the tenant improvements and commissions that go along with them. And those costs are higher than ever, with construction costs being up, and operating costs being up. And funding all of those is not easy today, right? So margins have gotten squeezed because leasing rates have either stayed the same or ticked down. It's very rare that anybody's been able to push up their leasing rates. And operating expenses are up 20 to 30%. So you get squeezed on the middle for those who are covering some level of their operating expenses. So yeah, those are the three sort of factors of where does office and any type of tenant demand come from? How do you fund deals in terms of when you do get the tenants? And as you keep them into the lease cycle, how do you keep those operating expenses managed so that you can continue to drive NOI, as Alex was talking about earlier? And I think, a lot of that is everybody needs to find their way to be as opportunistic as possible to drive rates, drive whatever margins they can, wherever they can. And I think that's the benefit of being able to be focused on any particular segment of your business, to be able to find that out. Because honestly, the trying to be sort of hands off and lazy, there's just not enough juice in the market today to be able to do that. You have to be really good at whatever you're doing.
Yeah, no, that makes sense, and it's insightful, especially considering the portfolio of tenants that you guys have in the niche market is a lot different than maybe the tower office building that Steve or Ellie is talking about.
I think as far as supply goes, I think you hit the nail on the head. What you tend to find is that supply is built upon itself. So these markets like Austin, like Nashville, Charlotte, to some extent, they just got so overbuilt in a very short window. They're supplying the market with 10 to 15% inventory growth, and waiting around a little bit for the population growth. We're starting to see some of that be absorbed now. So absorption rates are really strong. But when you're delivering tens of thousands of units in a particular city or environment, you either need relocation or lifestyle changes. The housing market has helped a little bit with lifestyle change because people aren't able to find homes as quickly as they like, or they don't like the mortgage rate that they have to pay now. So they're finding themselves an apartment. One of the stats that we track, which we find really interesting, is the average age of our tenants has gone up 30%. We used to house mostly young 30-year-olds, and now that average age is actually making its way into the 40s, meaning that well-to-do, high demographic tenants are actually sticking around longer. Buying a house is our number one reason for move out, especially in luxury product. There are many buying home opportunities today, both from a cost standpoint, from a rate standpoint, and market selection matters for people who might not be planting roots for like the long term. So when we think about supply, we definitely think of it as a sort of pockets throughout the country. And in some instances, supply can be good. Supply can establish a market. It can bring more folks into certain pockets and make them more investable. It can attract institutional capital, giving the ability to deploy capital there. Where the mistakes come is when people either overestimate or overproject how long it's going to take to get through that supply. So if you're going into a market and you're anticipating 4 to 5% rent growth, and there's 10,000 units behind you getting delivered, and you got -4%, you've obviously missed all of your projections. Certain markets are so far into their supply now that everyone's kind of in agreement of what the near future looks like. So you don't necessarily have to overpay for some of those opportunities. And in certain instances, you're actually getting paid to take on that risk. And every pocket is not the same. We track markets that are, maybe 2 years away from their peak deliveries, or maybe a couple, maybe a year and a half at the most away from their peak deliveries, versus some that are their peak deliveries are a couple quarters behind them. So if you can, weather the storm for a few years, I mean, and Ellie's hitting on quite frequently, and I think it's important for private investors as well. If you have the right term in mind, you can pay and project, almost anything. Long-term horizon in these pockets that have high supply, they have high supply for a reason. It's because people believe in their futures. So, we don't invest in those markets, but if giving advice to anybody, it would not be to be totally shut off or scared from an Austin, a Charlotte, and Nashville. Those are great pockets within the country. Maybe that's a segue to, your other question is, what keeps us up at night as multifamily owners? Frankly, it's over-regulation and over-taxation. Those are the two boogeymans in our game, for lack of a better term, that, for example, we recognized occurring in Maryland a few years ago in 2021. The Montgomery County specifically, but many of the counties in Maryland, overly regulated, rent caps, rights of first refusals on purchase opportunities, dried up liquidity. We saw that coming and exited immediately. As everyone on this call knows, real estate moves a lot slower, right? It's not selling a stock. You can't just go out and press a button and like you're out of the position. It took us 2 years to get, out of that position. So sometimes you have to be really forward looking to implement your business plan. But when we see things like that coming, that scares us, because you can push rent, or in some instances you can't push rent. So if you can't push rent and your taxes and expenses are going up and liquidity is drying up, you're asking for a bad investment.
Yeah.
But the opposite is true in certain pockets as well. Pro-business friendly states, less regulatory states, red states, frankly, is a major theme in multifamily investing right now, and I think for good reason. So those scary situations are out there. There are ways to mitigate them, and I think selection of managers, selection of geography, it's all very important at scale.
Let's wrap up by sharing one piece of advice for investors, or why an investor would want to work with you, or why we should be allocating capital to a firm like yours, and what makes you guys unique and what makes your investment strategy unique, so that your specific brand of commercial real estate can help our investors for the next, 5 years, 10 years, 100 years, whatever the case may be.
Yeah, sure. So I think in our strategy, it starts with being nimble, right? So the whole idea of the strategy is to be highly opportunistic. And so that means you're not constantly invested in catching the down cycles. And hopefully that also means we're coming in with a very objective lens into everything we do, every silo we do. I think over time that actually drives a lot of outsized performance and a lot of dividend and steady income with a lot of certainty as well. So again, I go back to looking at those mortgage REITs I mentioned. I mean, it's not only about what you know, but it's about what everyone else knows, right? So if our competition is an RIA that's put their money into a dividend fund blind and is looking for a 9% yield, and suddenly the world blows up, well, they know nothing about that underlying real estate. So we can take advantage of all that depth of expertise to get that huge advantage knowledge over the market, and then hopefully invest your money as a very sound fiduciary.
What we're able to provide our investors is long-term value through both current income and appreciation. At the level that we invest on an institutional nature, we provide a lot of stability and value given the liquidity in our markets. And the selection of the geographies that we choose and the product that we choose, we think has many tailwinds from a macro basis. So the investors that are attracted to us are folks that are looking for long-term value, steady state, and from a private investor standpoint, we can also offer many tax advantages. And as far as advice would go, what we think is a competitive advantage for us in this current environment is the long-standing consistency in performance and tenor in the market. In this environment, especially in a tumultuous environment or volatile environment, you want to go with somebody who has been doing it for a long time. And, we've been in business for over 50 years, and we think that that leads to the best relationships, the best opportunities, and the best performance. This is, likely not a time to be picking new managers. This is where you typically want to go with someone who has a steady hand, who has seen many phases. And, our investors like that a lot about our team.
Sure. First and foremost, I would say in real estate, probably more so than in traditional equities, having comfort in your relationship with the manager, operator is probably more important than in maybe some other financial markets, particularly because you're relying on projections as you move into these that are going to last for a while. And in many of them, you have to balance some level of illiquidity. And so it's a combination of finding, are you feeling comfortable with this advisor, but also, are you comfortable with what the profile of this investment would be? You need to balance, and many times, the liquidity with how you feel like it sets you up for the risk profile, right? As an advantage to ours, you're getting a very direct investment in the form of a limited partnership, best tax advantages typically. And also we're designing them so that they're done on a deal by deal basis so that you're not in any sort of blind pool or anything like that. And oftentimes in this sort of hyper local setup that we have, many times you're dealing with pieces of real estate that are familiar to people. So that's something that is unique to our sector of how we do our business, and something that I think resonates with people. People can drive by it, people see things happening, and that's something you get with us that you don't get out of some larger type of investments. But it comes with a trade-off. We're typically looking at a designed horizon of time, but within that, there's not a lot of liquidity. So it's finding the right profile of investment, because there are many different makeups and setups for how real estate can be invested in. So each one has its own merit and own value, and it's when you marry all the factors up together, what's the best fit in terms of a total scope of what the investor's looking for.
Yeah, I think one of the benefits of the BGO platform is that because we are large and geographically diverse, that we've been able to cultivate a pretty broad network of both local and national relationships. And I think this benefits us in a couple different ways. We can access the best operators, access the best talent internally. And then this also helps ensure in terms of deal pipeline that we're always the first or one of the first calls when there's a transaction that someone's trying to figure out, because we are well capitalized and we have certainty of closing, and we're active in all of these markets. So I think that carries a lot of weight when we're actually executing. And I think another benefit similar to this is what we've seen over the last couple of years is a lot of managers are sort of working through distress across their own portfolios. Is we've built these really strong lender relationships, and that's really become important in an environment where you're managing your existing debt portfolio in a way that's more critical than ever, and trying to plan how you're going to manage upcoming refinancings, upcoming new acquisition debt. And we've seen, I think, a lot of benefits from how strong of some of those relationships are.
Thank you guys again for your time interacting with us and helping us explain to our investors how the real estate market works. Each one of your insights was extremely helpful. It helps show that our investors can get a variety of different opportunities within the same asset class, and show why you want to invest in each individual one, whether it be nimble, whether it be niche markets like Nick, or whether it be long-term plays that should be an important part of your portfolio forever, like Ellie and Alex. But thank you for your time. I hope you enjoyed watching.